With premiums rising across the board, with all of the insurances that are around there, are you looking at the money that you're spending on insurance premiums and wondering which ones you should keep? In this video, I'm going to walk you through the differences between the income protection and trauma insurances. In case you're tossing up between the two, which of these covers you should keep. Hi guys, welcome back to the channel. My name's Craig and I'm a self-confessed insurance nerd. On this channel, I try and humanize the world of insurance and provide peace of mind for you and your family. Back in 2016, I wrote a LinkedIn article about Afterpay. At the time of writing this article, the share price for Afterpay was at $2.45, and I was asking the question whether this was a modern day lay-by or a trap for young players. If you haven't seen the journey for Afterpay and the share price tracking, today's price for the Afterpay shares is $108.33 per share, and I bought absolutely none. The reason I'm telling you this story is to highlight the power of hindsight, and the only thing better than hindsight is foresight, and that is the idea of this video. I want to give you the foresight to help avoid cancelling your policies hastily and potentially later regretting it like I did missing that Afterpay boat. So here are 13 differences that I've come up with that highlight the real differences between income protection and trauma insurance. To make this a little bit easier, I've broken it down into 3 broad categories as well, being product, applying and claiming. Firstly, let's have a look at the product design and how this differs between the income protection and the trauma. The first thing is the difference between a lump sum payment and regular payments. Now with trauma insurance, you might notice that you've got a sum insured figure, and that will be on your policy. And what this sum insured figure shows you is the amount of money that would be paid in a lump sum upon diagnosis of one of the conditions that are listed on the policy. In contrary to that, with an income protection policy, on your statement, you'll see a monthly benefit amount. And this monthly benefit amount is the regular amount that would be paid to you whilst you continue to be eligible to claim on that policy. That leads me to point number 2, which is the purpose. So if we know that there's a difference between a lump sum and a regular payment for these two policies, we can start to have a look at the reason why you might have each of these covers. Now, trauma insurance for me is designed to give you absolute choice. Choice of who looks after you when it comes to any medical conditions that you may have. Choice of how long you want to take off work should you be diagnosed with one of these medical conditions, or without any fear of any gap payments that you might have from any of these medical specialists should you go down that path. As I touched on before, that lump sum payment is paid into your bank and you have absolute choice on how you would like to spend that money, giving you the best chance to get back on your feet as quickly as possible. Secondly, with the regular nature of the income protection payments, you can start to think of what the purpose of these would be. Should you be unable to work and your employment income stops, these regular payments are designed to do exactly what your income normally does. Cover off on your regular expenses, take care of the bills, and also give you some money to live off. The third thing to have a look at is the tax deductibility of the premiums that you pay. Firstly, the trauma insurance, given the nature of this cover and the way that it's set up and the way that it's paid, the premiums for trauma insurance are not tax deductible, even though they have to be paid for from your bank account. Income protection, on the other hand, is generally a tax deductible expense, whether it's held through your super fund or paid for personally. If you'd like to check out my other video on the income protection details, you can check it out up here too. So that leads me to the structure and whether you can have it inside or does it have to be outside of super. And that's different for the two policies as well. For the trauma insurance, given the nature of the policy, these policies must be held outside of your super fund. Now in years gone by, there were some advisors that were setting this up for people through their self-managed super fund. So if you do have a self-managed super fund and your policy's been in place for a while, you may have this through your superannuation fund. But that's probably just going to confuse you. It's unusual that that would be through super, and as a rule of thumb, trauma insurance needs to be outside of superannuation. With income protection, on the other hand, you do have some flexibility to own this personally or own it through your superannuation fund. You can be fancy with the structure of this and have part from super, part from your bank, but essentially, income protection, you do have the ability to own this through your super fund. The next thing I wanted to have a look at was pricing, and this was one of the big things that I found when I searched online with some quite misleading information. A lot of these blogs were saying that the cost of income protection was higher than trauma, making trauma cheaper than income protection. Whilst the true cost of the cover may be less, i.e. the amount that you actually pay from your bank account, the relative cost for this cover is actually not quite the same. So I've highlighted this with an example of a 40-year-old male looking at a couple of different policies. Firstly, we'll have a look at the trauma insurance for $250,000. The cost of this this would be about $75 a month or $900 a year. For income protection for that same person, the 40-year-old, we're looking at a benefit of about $100,000 a year, meaning protecting an income of about $135,000. Now for this person, if you were to claim yesterday, the amount of benefits that the insurance company would pay you would be close to $2.5 million, being the $100,000 over the next 25 years until you turn 65. When we looked at price for this policy, it would be about $110 a month for this level of cover. Now, without looking into this further, on the surface, you'd say that the income protection is more expensive than the trauma, like most of the blogs out there have said. But I'd encourage you to think about the potential benefits from those policies. The trauma insurance would pay you that lump sum of $250,000, which would cost you $900, where the income protection would pay you potentially $2.5 million, costing you about $1,300 a year. Therefore, the potential benefits from the income protection are 10 times that of the trauma, yet the premiums are only about 1.5 times. It's for this reason that I explain that trauma is more expensive, dollar for dollar, than the income protection itself. So let's have a look at the next category, which is the differences in applying for these two types of cover. The first point to have a look at is how easily could you self-insure for each of these policies. Trauma insurance essentially provides you with a check for a certain amount of money that you predetermine. If you have cash or investments or all those sorts of things that you could sell down or could use in the event of one of these medical conditions happening, you could actually self-insure and have no need for this trauma insurance. For me, I look at a suggested minimum amount of $250,000. So for some of you, you may already have access to these liquid investments or investments that you'd be prepared to sell up to and equal to this value. In my opinion, typically income protection is a lot more difficult to self-insure for. Given that the income protection pays you that regular monthly amount, depending on how much your monthly benefit is, you'd need to have investable assets that provide you with a passive income equal or greater than your monthly benefit. From that previous example, I'm sure you can see how, in my opinion, it's easier to save the amount to self-insure for trauma insurance, being that lump sum of a minimum of $250,000, versus the income protection, which from the example before was a passive income of about $8,300 a month. A lot more difficult to come up with that regular income stream from outside of our work. The next thing to have a look at is applying for certain occupations. Given the nature of the trauma insurance policies, it's more accessible for those of you who may be in high-risk occupations. Think about firefighters, policemen and women, even nurses who are considered more high risk from an income protection perspective. Now, the way the insurance companies treat risk is the higher the risk of claim, the more expensive the premiums become for you. Given that the risks for the insurance companies are relatively similar in some of these high risk occupations as they are in lower risk occupations, you don't notice as big a price discrepancy between trauma insurance for different occupations as you do with income protection. The reason I'm telling you this is that if you're in a high risk occupation and you're looking at income protection, you might see the pricing as being something that's a bit of an obstacle. With trauma insurance, on the other hand, if you're applying for that same cover in that high risk occupation, you'll notice that those premiums aren't that different to someone who may not be in such a high risk occupation itself. The next thing is underwriting again for certain conditions. Now, underwriting is the process of the insurance companies assessing the risk that you present. Again, like the high risk occupation, there are higher risk medical histories than others. When we're looking at the risks, we really have to look at what the common sources of claims are for these two different policies. Now, with income protection, a bulk of the claims come from mental health and musculoskeletal as well as accidents. And for the trauma insurance, the majority of claims come from heart attacks, cancer and stroke. Now, some of the common things that I see from the people I work with, and even me personally, is exclusions for backs, given we've had osteo, physio, chiro. Also for mental health, if we had any mental health plans in the past. When it would come to an income protection policy, it'd be very likely that these things would be excluded, depending on your medical history, given the fact that these are common claim types under the income protection. If you presented with these same medical conditions and we're looking at trauma insurance, depending on that medical history again, you may find that you'll have a policy without any loadings or exclusions, given that these aren't things covered under the policy itself. Finally, I just want to have a quick look at some of the key differences when it came to claiming. Firstly is the concept of listed conditions versus the doctor's certificate. For a trauma insurance policy, it's very prescriptive in the types of things that are covered under the policy itself. Generally, there's about 40 plus conditions that are each broken down by each of the different insurance companies that outline exactly what it would take to claim on their policy. Comparing that to the income protection, there aren't the same listed conditions that are outlined on the policy itself. And what's required for you to be successful for a claim for income protection is for you to obtain a doctor's certificate and be under medical treatment saying that you cannot work for longer than your waiting period. Therefore, unlike the trauma insurance, it's less prescriptive in the things that need to have happened for you to have a successful claim. The next idea is the concept of being paid upon diagnosis versus requiring the ongoing inability to work. As I mentioned previously, the trauma insurance has a listed amount of conditions, each of which, if you satisfy the conditions of the policy itself, you will be paid a lump sum up to the amount that you've insured yourself for on your policy. Income protection, on the other hand, requires a more ongoing involvement from your medical practitioners. Generally, on a regular basis, the insurance companies will require you to fill out a form yourself and also have your doctor submit a form for those regular payments to continue. The doctors, in their opinion, would have to say that you're unable to work, which would see you qualify for that regular payment from the insurance company. Unlike the trauma insurance, which is submitted once, lump sum paid, the income protection does require a lot more involvement from both you and your doctor on an ongoing basis. The next thing I want to have a look at is the taxability of the proceeds in the event of a claim. As mentioned, the trauma insurance is a once-off lump sum payment that's paid to you upon diagnosis of one of the listed conditions. If successful, this lump sum payment made to you is completely tax-free. Income protection, on the other hand, the monthly benefits that are paid for you are taxable. So the amount that's listed on your policy as your monthly benefit is before tax, and the amount that will be paid to you from the insurance company will be net of any tax that would be payable on that income. This relates to my earlier point around the deductibility of the premiums. Given the nature of the policies and the way they're paid out, the trauma insurance, lump sum tax-free, premiums not tax deductible, income protection, regular payment taxable, therefore the premiums are actually tax deductible themselves. The next thing is the likelihood of claim. As with all statistics, they're all an average and do depend on a wide range of factors for you yourself. Broadly speaking, the chances of you having an event that would lead to a successful trauma claim is about 1 in 3 before the age of 65. Income protection, on the other hand, is roughly a 1 in 4 chance of you having a claimable event, again between now and 65. It doesn't actually require to be unable to ever work again with the income protection. It would just be an event that would lead you to a claim for at least a period of time. Finally, one of the differences is the ability to claim multiple times on these policies. Generally speaking, the trauma insurance is a one and done type of payment. You get diagnosed with one of the medical conditions, you get paid from the insurance company. In saying that, there are a few benefits the insurance companies offer that you can reinstate your policy at a later date if you have elected to do that, which is really common. But generally speaking, it's a once-off payment designed to come to you upon diagnosis of one of those conditions. With income protection, on the other hand, recurring claims are very common. Now, you may recall from earlier some of the common things that lead to claims: mental health, musculoskeletal, and accidents. With each of these events, you could see how the nature of your injury or illness could fluctuate. And with that fluctuation, you may see a period that you're on claim from your insurance company. You can go back to work for a while, you may have a recurrence, and therefore recurring income protection claims are actually really common. Now, I know that's a lot to take in, and if after watching this video, if you want to have a look at the principles-based approach that I use for working out how much insurance you should have, check out this video that'll walk you through the process for yourself, and I'll see you over there.